Everyone wants to talk about the software side of artificial intelligence, pouring trillions into training models and designing next-generation chips. But all that digital ambition crashes into a harsh physical reality. Someone actually has to manufacture this hardware, and building silicon for AI is one of the most unforgiving processes on Earth. When you are layering billions of transistors onto a single wafer, one microscopic flaw, a speck of dust or a microscopic misalignment, turns millions of dollars of cutting-edge computing power into expensive sand. To stop that from happening, chipmakers rely on a step called process control. It involves scanning the silicon throughout the manufacturing cycle, finding and fixing defects before the entire batch is ruined. This chart illustrates the process control sector, and that massive 58% slice belongs to a single company. That company is KLA Corporation. They don't design AI models, and they don't manufacture the chips. But they sit squarely on the critical path of AI expansion, providing the strict oversight required to make advanced manufacturing possible. Trading this stock has been a bumpy ride lately. Shares slipped about 10% over the past month before managing a sharp rebound. To make sense of those price swings, we need to look under the hood. We have to see how a business that acts purely as an industry inspector commands a staggering $266 billion market cap. The clearest proof of KLA's leverage came on July 28, 2026, when they released their fourth quarter financial results. Take a look at this bar chart showing the company's recent quarterly performance. KLA posted record quarterly revenue of $3.66 billion, carving out a 15.2% jump compared to the exact same period last year. They easily cleared Wall Street's consensus. Analysts were expecting $1 per share in adjusted earnings, and KLA delivered $1.05. When we zoom out to the full fiscal year ending in June, the scale becomes even more apparent. The company pulled in $13.58 billion in total revenue, yielding $4.83 billion in pure GAAP net income. Even more telling is their profitability. KLA reported a 62.4% gross margin, landing at the very top end of their own guidance and highlighting a remarkably efficient operation. Margins that high rarely happen by accident. They show a company that is actively dictating pricing terms, because semiconductor plants literally cannot run with their equipment. A major reason chipmakers keep buying that equipment comes down to a technique called advanced packaging. As individual chips reach their physical limits, manufacturers are stacking them together, requiring entirely new layers of precise inspection. KLA sees this specific segment exploding. They recently raised their expectations for advanced packaging revenue to $1.1 billion for calendar year 2026. That represents over 70% growth compared to the prior year. Then there is the software and services side of the business. Once KLA sells a machine, they secure an ongoing relationship to maintain it. In the fourth quarter alone, services generated $820 million. Management has set a steady, long-term growth target of 13 to 15% for this service division moving forward. By expanding this high-margin ecosystem, KLA creates a buffer for itself. Even if new hardware orders slow down, the recurring revenue from software and maintenance keeps the cash flowing, and they are aggressively distributing that cash. Over the full fiscal year, KLA returned $3.35 billion directly to shareholders through repurchases and dividends. To make those shares easier to acquire, the company split its stock 10-for-1 back in June of 2026, instantly opening the door to a much broader pool of retail investors. Shortly after, the board declared a fresh quarterly cash dividend of 23 cents per share, payable at the start of September. Wall Street responded exactly how you would expect. Zacks Research upgraded the stock to a strong buy, and analysts at Wells Fargo pushed their price target up to $305. When a company combines aggressive buybacks with dividend hikes and stock splits, it signals an executive team convinced that this AI infrastructure build-out is going to last for years. But sitting at the center of the industry also makes you a target for its biggest structural risks. KLA's massive revenue relies heavily on a small group of leading-edge manufacturers, meaning a pullback from just 2 or 3 top clients would hit the bottom line instantly. KLA faces severe geopolitical exposure in China. With ongoing U.S. export restrictions blocking specific trade routes, the company is locked out of certain customer bases. Additionally, gross margins dropped 100 basis points due to component inflation, tariffs, and supply chain limits. Hanging above all of this is the historical cyclicality of the semiconductor equipment sector. It is an industry built on massive boom and bust cycles. Despite these headwinds, management remains relentlessly optimistic. They actually just raised their total market outlook for 2026 wafer equipment to the low $150 billion range. KLA Corporation certainly faces genuine geopolitical and cyclical threats, but taking a position here means placing a bet on a very specific reality. As global AI technology pushes against its physical limits, every single microscopic defect has to be caught, and KLA owns the gate.